Good afternoon. Good afternoon. It's Monday, the 9th of March. Welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities in Singapore. Oil has jumped the most since 2020. It's crossed the $100 mark. And the markets around the region are responding with a sea of red. The CI is down close to 3%. Responding to the risk-off sentiment across equity markets. We get some perspective of this. What does oil prices at this current level mean and its impact to ASEAN markets with our co-head of economics, Dr. Hagbin Chua, who's joining us. Then we go over to Malaysia and discuss the outlook for the Malaysian banks with analyst Desmond Ching, and we'll also ask him about what the current macro situation means to the sector. Domestically, we highlight some key small and mid-cap stocks in construction, in AI, as well as non-bank financials with Zuan Hao after our recent corporate day. Plus, we've got some fresh charts from our chart guy as well. So a lot to discuss today, so stay with me. And let's start with Hagbin, and let's start with and with oil. Hagbin, welcome to the show. Now, the macro team has looked at past Middle East conflicts and make a very interesting observation. Global macro impact where crude oil has been dissipating over time. Why is this the case? And what are some of the lessons that we can take away from the current oil price hike?
Well, I mean, the global oil intensity in the whole world has been declining. It takes fewer barrels of oil to produce growth, but it's still Asia is still fairly reliant on oil imports and gas generally. So not as big as before, but still somewhat vulnerable. So within that ASEAN space, Malaysia is the only one which is a net energy exporter, and Indonesia has also become a net energy importer, and Singapore, as well. So typically, it's Thailand, Singapore, Philippines. I guess a bit more vulnerable to the oil price shock, to different degrees. So depending on how the situation plays out, but it is not just a pure kind of oil price shock, which we kind of saw from the Ukraine-Russian war. It's also a supply disruption, a supply shock, because you can't even. There's plenty of oil in the Middle East, but the problem is, they can't even get it through, right? The Straits of Hormuz. So and then to worsen that, there's also a bit of a shipping shock as well. So you got three different shocks acting to varying degrees that may impact growth and outlook, including for Singapore.
Got it. So maybe let's just go down to the key markets in Southeast Asia, maybe Malaysia, Singapore and Thailand. Well, Singapore will take in the next segment, but maybe if you can give us a little bit more color on how you see the different ASEAN countries impacted from this, and where do you think the risks to inflation as well as currencies lie in this current situation?
So I guess there are different angles. One is the net export side, which is only Malaysia will have be somewhat of a beneficiary. But of course, it could have been a bigger beneficiary if it didn't have all this generous fuel subsidies, right? Which has been unfortunately using all the producers for consumption rather than exporting at much higher prices outside, right? But it's good that over the last few years it's been rationing that. But the most oil dependent would be still Philippines and Thailand, and from that sense, it's very vulnerable. On inflation, pass through to various degrees is kind of shielded and tapered because of the subsidies, particularly in Malaysia, Indonesia, and also a bit in Thailand. But basically, inflation will be felt the most in the Philippines, and then potentially also in Indonesia, in Vietnam, Cambodia. Those countries which have a current account deficit, like Philippines and Indonesia, may be a bit more vulnerable because the external balances, the current account deficit will rightly widen, right? At a time when the peso and rupiah are particularly vulnerable. So that's one thing we probably have to be mindful of. Yeah, so inflation shock is there. Oil prices have risen quite a bit. So realistically, if it stays at $100 level, some of the central banks in the region might not be able to ease anymore. We were penciling 2 more rate cuts from Indonesia, but given the pressure on the rupiah and also in the inflation, they may not be able to cut rates. Similarly for the Philippines or even Thailand. In Singapore, we are penciling a tightening already in April, and we expect now with the potential increase in inflation, if this continues, probably inflation will rise above 2%. That they will have to tighten in April, a steeper appreciation bias, which could be, I guess, good from an investor point of view, and then potentially a second one, because if this conflict doesn't end within the next 3 months or so.
What about other macro stress? I mean, when you look at periods where we've had high oil prices in the past, how has Singapore responded, and how do you think, where do you think some of the pressure points will be?
So I think, the closest one, the last one we had was the Ukraine-Russian crisis, where prices did spike, and the impact slightly negative, but wasn't as bad. In particular, I think some of the Russian oil price was also diverted into other countries. So I think there's a supply there was still available, and OPEC Plus managed to increase supply and also to cushion that impact. The problem is that OPEC cannot even do anything now, even if they want to increase supply, because 20% of that all exports goes through the Straits of Hormuz, and that's stuck. Singapore also imports quite a bit of its natural gas from Qatar, which is also affected. So the impact typically will be felt by the aviation sector, which we could be given a higher fuel cost now that will probably eat into yields. But Singapore Airlines and Changi might benefit from the divergence of some of these flights from Dubai, say. Manufacturing, a lot of cost of production will go up. Petrochemicals and all that may not even get the inputs they require. The utilities bill will be increasing. So that's something we have to watch. I think the data center boom is still all right. We were penciling growth as driven by electronics, but and I think it'll still stay positive growth, but the growth may have to be tapered. There are already stories of helium, which is one of the ingredients required that comes from the Middle East. The supplies may be impacted, for example, right? And of course, data centers are energy guzzlers, right? So can all governments continue to allow data centers to run at such high energy intensity given what's going on? And of course, shipping you could benefit now from some of the diversion of shipping and routes, but also and shipping is big. Shipping is 7% of Singapore's GDP. So, but will this be affected by the diversion of routes, the high shipping costs, which would also curb consumption? So there are a lot of different channels that are still in play. I mean, I think good news for Singapore, as in the other previous episodes, is the government sits on a pretty strong balance sheet. That this budget for this year, they already set aside a big surplus, roughly about 8.5 billion. The Minister Gunn has already come out to say that they're prepared to draw on it if necessary. So I think at the very least there'll be all these utility rebates, some electricity rebates, some support there for the SMEs that might be affected by the jump in energy costs. I'm not sure whether they go as far as the jobs credit scheme that they did during the pandemic and the GFC yet, because I think it's still early days. Maybe some help in some of the insurance issues if there is for certain sectors. But yeah, I mean, just good news is that from the Singapore is a bit more shielded from the currency side and from the fiscal side, and of course it's got a huge current account surplus. So even if there's a surge in the cost of all imports, it will still be a comfortable current account surplus position.
Got it. So certainly premium. Thanks, Hagbin, for that. So let me just add to what Hagbin said, which just from a equity and sector point of view as well. I mean, as he said, if oil prices remain at sustained high level, and I think that the key word here is whether it's going to be sustained. Then we are going to see increased input costs across multiple sectors and inflation risk, as he said. Transport will be one of the main impacted, particularly jet fuel costs going up, plus airspace disruptions and so on. But some of this most likely will be partially offset from fuel price hedging as well, and fuel surcharges as well. On land transport, we may see higher cost pass-throughs and near-term tighter margins for taxi operators. We also see elevated risks on higher public transport fees as well. On the consumer segment, especially consumer staples operators, there could be risks to supply chains being disrupted and also higher operating costs from oil prices. For banks, I think the bigger issue is NPLs, especially for SMEs, which may see some pressure. So we'll have to see whether there will be some government support there. There are incremental positives also for across sectors, banks, non-banks, healthcare, industrial, small and mid caps, internet platforms, and telcos. The key beneficiaries would be some of the defense names like ST Engineering and Add Value Tech, which could see better order visibility. Small and mid-cap names in the oil and gas and ship chartering space like Marco Polo Marine, Benquang should also benefit. In financials, DBS, OCBC, UOB remain relatively insulated on direct exposure, but they might actually gain some safe haven flows of assets under management, particularly from Dubai, and this will also benefit names like iFast as well. For healthcare, internet, telcos are largely removed from direct impacts. Most of that is geared towards domestic demand. So if you do see the government flexing its balance sheet, we may see some shielding there. So overall, we think Singapore's structural certainty premium will actually come into play even more. So we do see some of this weakness in the current prices are opportunities to look at some of these stocks right now. Now, with that, from Singapore, I want to move to Malaysia and bring Desmond in to the conversation. Now, Desmond, let's start with the elephant in the room. What will be the impact of a prolonged Middle East conflict on the Malaysian bank sector?
Yeah, morning, Dylan. I think just to reiterate some of the things that Hakbin said just now. So when you look at the ASEAN region itself, Malaysia does stand out as a net exporter of crude oil, petroleum products, and gas combined, simply because the trade surplus in gas offsets the trade deficits in crude oil and petroleum products as a whole. But essentially, our economics team does acknowledge the fact that a 10% sustained rise in crude oil price not only impacts the global growth by about minus 0.2 percentage points, but that a 1 percentage point cut in world GDP growth would negatively impact Malaysia's GDP growth by 0.8 percentage points as a whole. But generally, for the banking sector, we've maintained our constructively positive stance on the sector, barring any long-term implications on the economy from this Middle East war itself. Generally, there are several factors there. Firstly, if you take a look at the operating environment this year, we had projected GDP growth to hold firm at about 5.1%, and we are projecting operating profit growth for banks to strengthen from 3.4% last year to about 5.3% this year. We expect this to be driven by domestic loan expansion of about 5% and stable net interest margins. Net profit growth, we think, will rise to about 5.7% from 4.5% last year amid benign credit costs as a whole, and for ROEs to edge up to 10.5% from 10.4%. So apart from the fact that we do think that operationally it should be better simply because of the expectations of stable net interest margins, margins actually compressed quite a bit last year. We are also of the opinion that the banks themselves actually provide some form of support in the form of the dividend yields that they offer. The dividend yields for the banks currently average just above 5% for most banks except for two, Alliance Bank and Hong Leong Bank. And I think what investors are holding out for this year would be the potential for higher than expected dividend payouts by the banks. The capital ratios for most banks are actually comfortable. And if you take a look at the banks within our coverage itself, we think that RHB and AMMB could potentially surprise against our own dividend payout forecasts. With regards to the other banks, we think that Public Bank could possibly do a capital management of some sort, since 2026 itself marks its 60th anniversary. And also in the case of Maybank, in order to meet their Raw 30 targets, which would be their 5-year financial targets, Maybank had mentioned the prospect of capital management plans as well. So there are still expectations that yields could surprise on the upside.
Got it. So improving ROE, stabilizing operations and capital returns as well. And with that, Desmond, what are your 3 top picks?
So at this point, our top picks are RHB, AMMB, and Public Bank. In the case of RHB itself, their capital ratios are pretty decent, and it had surprised the market with a dividend payout ratio of 65% for FY25 itself. We have assumed a lower payout ratio of 60% moving forward, just to be a little bit more conservative, because their payout ratio policy is actually 50 to 60%. But the point is that given the high capital ratios that they have, coupled with the fact that they do have excess capital at this point in time, we think that it could surprise and still maintain the 65% payout moving forward. In the case of AMMB, it has been proactively managing its funding cost, and its CET1 ratio is also comfortable at about 14.6%. We have assumed a payout ratio of about 50%, and there is room for this to move higher as well. Management has been pretty aggressive in terms of their targets, in that they are looking to, or they're hoping to actually double their absolute DPS over the next 5 years, which may seem a little bit aggressive at this stage. But so in our case, we have been conservative with the assumption of 50% payout. Public Bank, strong is the third pick. So essentially, asset quality is still strong. The thing about it is that the main problem with Public Bank right now is the share overhang issue, whereby LPI Capital is expected to place out a 1.1% stake in Public Bank. They have to do it by the 3rd of June this year, based on the recent 6-month extended deadline that was provided to them. And hopefully they don't extend this any further. There is also the issue of the distribution of the Tay family's 12.3% stake in the bank by way of a restricted offer for sale. Essentially, this one has to get started if this overhang issue is to see any clarity, actually. So this is the only thing that's holding it back at this stage, we think. And again, in terms of the payout ratio, it's currently about 60%, and we do not rule out capital optimization exercises in the near future, given that this year is the group's 60th anniversary.
Got it. Thanks, Desmond.
Thanks.
With that, let's move to domestic focus. We are tight on time, but let's bring Xuan Hao in. Xuan Hao, very quickly, last week we hosted 4 small and mid-cap companies PC Partners, Infotech, proxies to AI demand, Hong Leong Asia, proxy to Singapore's construction demand, as well as Aspia Lifestyle, a non-bank financial player. Maybe very quickly, let's look at PC Partners and Infotech as well as Hong Leong Asia. Zona, what are some of the key takeaways from these companies?
Yeah, so in terms of the key takeaways for PC Partners and Infotech, I think PC Partners, they are making crucial moves to distance themselves from direct China contact and moving to a China plus one strategy. So they have delisted from the Hong Kong exchange and relocated their headquarters to Singapore. And they hope to use this strategy to secure higher tier NVIDIA GPU allocations. So this would pivot them to higher margin AI server, the AI server markets, which is in line with the rising demand for regional data center and hyperscaler demand here. And as for Infotech's case, we'll see they remain to be a sales as a service leader. They have noted that 80% of their academy registrations are now AI related. So this can be seen as a positive, where management have emphasized that they are utilizing this increase in AI demand from academy registration as a cross-selling funnel for their core HRMS and accounting software. So moving on to Hong Leong Asia and the construction boom, they have emphasized that 20% of their ready-mixed concrete market share has they have 20% of ready-mix concrete market share and is dominating the local construction scene. So with this in mind, they actually plan to enlarge its footprint for new plants in Jurong Port. And this would actually continue to make them a key beneficiary of the local construction boom. Yeah.
Got it. So now, thank you very much for that. Let's move to our chart guy. We've got two brand new charts. One is from Singtel. It's just broken above its short-term downtrend channel, and it continues to trade above all their moving average lines. So our chart guy is calling for a trading buy on Singtel, and this gels with our fundamental view of buy as well on the stock. Trading sell on UOL Group. Current uptrend appears to be entering an exhaustion phase. So do have a look at more details in our newsletter today. I also want to highlight some events that are coming up. The main one, I think, outside the macro data, unemployment coming out on the 13th, inflation, which I think many of us will be looking very closely on the 23rd, given where oil prices are some key dates to watch out for. But also 11th of March, I think very, very timely is to look at gold as a strategic anchor. So do look at this event that will be out on the 11th of March. You can sign up through our newsletter today. With that, thank you so much for joining us. We are out of time. We'll see you next week. Have a profitable trading week.